All right. Hello, everybody. Thank you for joining us today. I'm Jay Kaeppel, Senior Market Analyst at SentimentTrader.com. I'm joined today, of course, as always, by my running mate, Dean Christians, Senior Research Analyst. Dean, how are you doing today?
I'm doing great, Jay. How are you?
Can't complain, other than the cold, but not so bad. So our topic today is what's new on the website. And now we've been pretty busy since the start of the year. And I have to give a thank you to our programming staff because they've taken a number of somewhat archaic ideas that I send them and they're able to turn it into computer code. So I'm very grateful for that. So we're going to take a look at these things. Now, one thing I want to remind you, we're analysts, not advisors. We don't have model portfolios and we don't say buy this and sell that. Our experience has been the most successful investors and traders are those who learn what they're doing and come up with their own way of doing it. So our job is to try to give you tools that are as objective as possible to help you be the best trader and investor you can be. So that's what we're going to look at today is some objective new indicators to give you some information. We put a lot of information on the website. All the good stuff goes in our notes. All the random thoughts tend to throw on Twitter, so you can view our latest thoughts there. Now, at any point in time, there are a number of factors that can affect stock prices, sometimes some more than others. These are some of the ones that I follow. And today we're going to focus on a handful of these with some new indicators. So let's just jump right into it. The first one is called the Sentiment Cycle Composite. And somewhere in the last year or so, I happened upon 4 indicators on our website that I hadn't seen before. So the goal here is to be able to look at this indicator and say, objectively speaking, sentiment is favorable for stocks or unfavorable. Try to take out the black and white. To get more detailed information, I wrote an article early in December, so you can take a look at that if you want to follow up, but we're going to go through it pretty thoroughly right here. So the indicators that are on our website that form the basis, sentiment cycle enthusiasm, and what you'll notice is that when the market goes down, enthusiasm falls hard. No surprise there. As stock prices fall, people get less enthusiastic. Another one is called returning confidence. And that one too, no surprise, drops when the market drops. On the other side of the coin, we have something called cycle panic, which tends to jump higher when the market goes down. And then discouragement does the same thing. As the market goes down, this level goes up. So what happened is I ended up adding enthusiasm and returning confidence. And you see the black line, how that fluctuates over time. This is about the last 20 years. And then added panic and discouragement, which is the blue line. And you can see how these tend to move in different directions. So in a bit of not exactly cutting edge analysis, I wondered, what would happen if you subtracted the blue line from the black line? Well, what you get is what has turned out to be what we call the sentiment cycle composite, and you see it here. Okay, it goes from low to high, high to low. And interesting, one thing that I really like about it is it sort of makes sentiment into a trend following indicator, which as a trend follower by nature, I kind of like that. So let's take a closer look. The simplest way possible to look at this is to see where it stands relative to a value of minus 0.60. That's kind of the line in the sand between bullish and bearish. Why do I say that? Well, this goes back into the early 70s, the hypothetical growth of $1 invested in the S&P 500 only when this composite index is above minus 0.60. And what do you notice about this line? Lower left to upper right. That's what I always like to see. There are some sell-offs along the way. It's not perfect, but lower left to upper right gives us good confidence. that the market will be bullish. On the other hand, during those times when this indicator is below minus 0.6, it's a bit of a hodgepodge. You can see it actually lost money over the last 50-something years, but that was mostly from a couple of big bear markets in the early 70s. I don't know if you can see my mouse, but the early 70s, 2000 to 2002, and then, of course, 2007 to 2009. At other times, it ends up being a whipsaw. The market goes down for a little bit, then turns around and goes up. But in the long run, we're much more confident about the market when this composite is above minus 0.6. So if we, in our backtest engine now, I ran this and just said, okay, show me where it crossed above and below. And you can kind of see the arrows and how it fluctuates. Sometimes it stays down in bearish territory a long time, sometimes not so long, all right? And it's been bullish since about late 2022, probably early 2023, I believe was the last signal. And here's kind of the summary. 80% win rate. The average win was 32%. The average loss was only about 4%. And it's in the market about 75% of the time, which makes sense if you're looking to reduce risk. You know, a certain amount of the time you're in a bear market. So this kind of seems to capture that. Another use I think I've found for this is in terms of a trading mindset. Well, I'm sorry, let me finish. This is the equity curve of the strategy that I just showed you versus the S&P 500. Blue is the cycle composite strategy return versus the S&P, which is the gray. But what I want to look at is when this indicator crosses above minus 0.6, if you are aggressive over the next 9 months, in other words, we just look at a 9-month holding period. Now, I never recommend people to trade leveraged ETFs, although I do it sometimes, and some people also do it a bit. But that's one opportunity to consider that type of aggressive strategy. And why do I say that? Well, because there have been 23 times when this composite index moved above minus 0.6, and what you see is on all 23 occasions, the S&P 500 was higher 9 months later. In the market 25% of the time. So again, from a trading perspective, when you see that number rise above minus 0.6, it's time to get aggressive, whatever that means to you as a trader. And then here's the equity curve for buying and holding for 9 months. That's hard to beat. And so let's see where we are right now. Well, we seem to be in a good place, right? The number's up pretty high, not too many concerns. Another way that I use this, more anecdotally, is if I get up tomorrow and I go on Twitter or Google and I see an article warning about something about sentiment is maybe turning bearish, or I look at this number and I say, you know what, I'm not going to read that article because objectively speaking, this indicator is saying sentiment is favorable on an objective basis for the market right now. So that is the sentiment cycle composite. Let's move on to inflation, the PPI, Producer Price Index stock market model. And the goal here is to objectively label inflation as favorable or unfavorable. If you want more information on this, I wrote a piece in late January. And so let's take a closer look at the model. Well, first, let's get a broader picture of inflation. This is the blue line here is the 12-month rate of change in the Producer Price Index going back over 100 years. And basically, above 9% we call too much inflation. Below minus 12% is too much deflation. Everything in between is basically moderate inflation. Now, the reason this is important is very simple. The stock market hates uncertainty. And few things cause more chaos and uncertainty for investors than soaring inflation or plummeting deflation. Throws everything out of whack. So I want to keep a close eye on this. But the other thing we know is inflation can remain moderate for many, many years at a time. So during those times, you can still get bear markets, but they won't be because of inflation. There'll be some of the other factors that I showed you earlier. And on the far right-hand side, you see a spike back in 2022, where that spike in inflation was the primary driver of the bear market in 2022. So you never know which factor is going to take the wheel. That's why I pay attention to most of them. So let me just give you a quick rundown. You don't have to memorize this because it's built into the software, but just so you know what's going on behind the scenes. There are 3 indicators. They're each worth 1 point. The 12-month percentage change in the producer price index. On that chart I just showed you, if it's between +9 and -12, that's favorable. Outside of those ranges, it's extreme. It's throwing investors out of whack. Indicator number 2 is the producer price index 12-month change minus the consumer price index 12-month change. As it turns out, the PPI tends to lead the CPI. So when it gets way out ahead of the CPI, that's typically a very bad sign. So when the difference between these two is less than 7%. So, for example, in 2022, the producer price index actually got up to about 21%, whereas the CPI was only about 9%. So that turned unfavorable for a while. And then the last one is the 1-month change in the producer price index. Big changes, either up or down, once again, cause uncertainty. So if it's between +4 and -2.2, that's fine, it's favorable. Outside of that range, we consider that unfavorable. So you simply add these 3 up and you get a number from 0 to 3, and that is our PPI stock market model. This is really useful for longer-term investors who really don't want to sell. They prefer to stay in their positions and not incur taxes or whatever. This can keep you in the market for a long, long period of time and only get you out when there's a serious situation, rising inflation or too much deflation. Why do we look at this one? Well, this one, again, going back, this one's 100 years. The growth, hypothetical growth of $1 in the Dow Industrial Average, if this model is equal to 3. Once again, it kind of speaks for itself. Yes, there are times when the market dips, but in the long run, you can be pretty confident that stocks are going to do okay. What if it's below 3? That does not look so good. You see the huge decline during deflation in the 30s. Then you had inflation in the 40s and the 70s, a lot of chop, a lot of bear markets. During the 08, while everybody was focused on real estate, there actually was a bout of inflation. And then you see 2022 over on the far right. So really important to pay attention to this because this can give you a very good warning sign. Now, in our backtest engine, I set up a test to make it trade less frequently. I set the rules so that if the model gets to 3, we'll buy the S&P 500, and we'll hold it until it gets down to 1. In order to avoid a few whipsaws where it goes from 3 to 2 and back to 3 and back to 2 and back to 3. These would all be trading signals. So we set it so if it gets down to -1, then we get +1, then we get a red dot until it gets back to +3. And how does that work out? Well, over this time frame tested, there were 12 trades. All 12 of them showed a gain. So again, that's what I look for, is reliability, something I feel that I can trust. And one interesting thing to note, don't try to read this screen. There's too many numbers, there's too much hieroglyphics, but basically you've got the entry date, the exit date, and the trade return. And what I want to point out is if you're a long-term investor, note that gave a buy signal in 1951, the next sell signal did not occur for 22 years. So that's a pretty good model if you're a long-term investor. If you didn't like that one, well, you can try the next one, 1975 until 2008. So we had 33 years that I showed you on a chart earlier of moderate inflation. Yes, there were bear markets in between along the way, but not based on inflation. So again, this is just a long-term model to help you stay on the right side. And here's the cumulative gain using the strategy going back into the 1920s versus the S&P. And where are we now? Well, we're at +3. So this is a favorable position right now. Now, some people say, wait a minute, all I hear about is inflation. It's driving me crazy. It's driving everybody crazy. Let me point something out. What we're talking about here is not how inflation will affect your pocketbook or the economy. It's what does the stock market think right now about inflation? Again, the stock market is a discounting mechanism. It looks forward. So when it sees uncertainty, that's when the problem comes. Once inflation gets into that moderate zone, the stock market tends to go, okay, that's not a factor right now. So right now, inflation is essentially at least not unfavorable, if not favorable for stocks. So that is the PPI stock market model. Another one we added, this one called LEISum, Leading Economic Indicators is what's that short for. The goal is to objectively label the economy as favorable or unfavorable. Now, for the record, I still tend to defer to our macro index model, which can range from 0 to 1. Readings above 0.7 tend to be favorable, below 0.7 tend to be unfavorable. Although interestingly, that's been unfavorable for several years now, even though the stock market's gone up. Well, how can that be? Well, as I said, there are a lot of factors that affect the market. And if the economy is just so-so, but there's other factors that are favorable, stock market, as we've seen in the last 2 years, can do just fine. So let's take a closer look at this one. Again, for more information, I wrote this one on the 4th of February, and I actually wrote it about real estate because this factor tends to affect the real estate sector by far much more than any other sector, both bullish. I think the number was up 57,000% versus the second best sector, 31,000% when it was favorable. And when this model that I'm about to show you was unfavorable, real estate was the only sector that actually lost money. If I get a chance, I'll show you that later. But right now, let's just take a look again, so you know what's going on behind the curtain. If the Conference Board Index of Leading Economic Indicators is what we're talking about. If it's above its 12-month moving average, we add 2 points to the model. If it's not, it's 0 points. And then we also look at the 6-month moving average minus last month's 6-month moving average. Is it up or down? What's the trend of that moving average? If it's up, we add a point. If it's down, it's 0 points. So kind of like the last one, this one can range from 0 to 3. All right, and so you can see it fluctuates over time. Just eyeballing this, you can see periods when it got down to 0 where the market didn't always do too well. But let's take a closer look. Now, again, this is looking at the real estate sector. When this LEISum is any value greater than 0. One more time, what do we notice about the equity curve? We notice exactly what I look for, lower left to upper right. So right now, with this back to a level of 3, that would suggest good things ahead for the real estate sector. Does that mean it's going to immediately explode and rally 20% in the next 6 months? No, but at this point now, I'm giving it a favorable look. On the other side of the coin, here's the growth of $1 in the real estate sector when this model is equal to 0. And you can see the ugliness and devastation, a lot of chop in the last couple of years. So it's something you want to avoid when this indicator is down at 0. Now let's take a look at this as a market indicator. So we'll look at the S&P 500 index. And we'll just say any move above 0 is positive. So I set the parameters. If it crosses above 0.5, i.e. it goes from 0 to 1, that's positive. That's a buy signal. You get a green arrow. and vice versa. If it drops below there and hits 0, then you get a sell signal. Now, I don't have the last green arrow, but there is a green arrow now. If you look over on the far right, you see this model just at the end of January got back to a 3. So you can see the upside here. How did the stock market perform? Well, during the test period, there were 13 green arrow to red arrow periods that you see here. All 13 of those showed a gain in the market 43% of the time. One thing I want to point out about all of these things is just because something has a 100% win rate so far, it does not guarantee that the next signal will be bullish, but that's the way that I'll be playing it. And then once again, this screen, I put it in here and then I realized there's way too much information and it's pretty difficult to read, but you can basically see the trade returns and the dates, in 6 years from 1983 to 1989, 141% gain. Again, for longer term investors, sometimes this can be helpful in just keeping you in the market. And here you see the equity curve for this particular approach. And like I said, here's where we are right now. We just got back to a +3. So that's bullish for stocks overall. It's especially bullish, historically speaking, for the real estate sector. So don't be surprised if that market starts to move sometime in the next 12 months. So keep an eye on that. All right, moving on. As I said, our programmers have been very busy keeping up with all this stuff and getting it into the software. TNX range percent. TNX is the 10-year treasury yield, and the goal is to objectively label interest rates as favorable or unfavorable. Again, you go on Twitter and you'll see 1,000 predictions of rates are about to come down, and other people will say exactly the opposite. And our goal is to be able to say, well, based on historical precedent, here's realistically what we think should happen. So again, for reference, I'll take a look at a piece I wrote on January 30th about interest rate trends and stock prices. This one is a lot of movement. This is a little different than the other ones, right? So what this is looking at, it's a weekly indicator that looks at where the yield on the 10-year treasury note is. So when bond prices go down, the yields go up, vice versa. Where that yield is based on its own 13-week range from 0 to 100%. And what we say is above 83% is unfavorable for stocks and vice versa. Let's zoom in just a little bit on the last couple of years, and you can see this moves around a lot. This is definitely more of a shorter term trading type indicator. But if you look at some of these periods where the number was up pretty high, even in the last couple of years, that tends to be the time when the stock market had some trouble, showed some weakness. So here, going back into the 90s is a hypothetical equity curve. Growth of $1 in the S&P 500 when this indicator is below 83%. And what you see is it's far from perfect. And part of the reason for that is interest rates are a very important factor in the stock market, but as I keep saying, it's not the only factor. There are a lot of things that can happen. So over here, you see some pretty severe bear markets, and this particular model didn't ride them too well because interest rates weren't the problem in 2000 to 2002. That was overvaluation and the bursting of the dot-com bubble. In 2008, we had some inflation. We had the housing bubble. Interest rates weren't really a factor. But as you can see, since then, with the exception of COVID, pretty good results on the long side. And again, looking at the flip side, when this indicator is above 83%, here's the performance of the stock market, the S&P 500, all over the place. So again, you can't really call it necessarily bullish or bearish, but you can call it a favorable factor or an unfavorable factor as part of a weight of the evidence approach. And then here you see kind of the signals that it's giving. when it crosses above 83, technically that's bearish, but you're getting a green arrow, and you can kind of see how this goes back and forth. And here is the equity curve. Now, again, this one only in the market 24% of the time, about a 70% win rate. Average win, average loss, much smaller than some of the other longer term ones. But again, we're talking about more of a trading indicator. And again, since about 2008, the long-term results have been pretty good. So this is basically a once a week indicator to tell you how the interest rates are influencing stock prices at the moment. And right now we are below 83%, so I have this ranked as favorable for stocks at the moment. And then the last one that I want to show you is called the Titanicburg, which is a silly name. However, the reason is it combines the Titanic syndrome with the Hindenburg omen, which, if you've not heard of those, the Titanic syndrome, just spell it right out. If the S&P 500 closes at a 52-week high within the last 7 trading days, and the new 52-week lows outnumber the 52-week highs, we get an incidence of the Titanic syndrome. And basically what it's looking for is churning in the market. In other words, the index looks like it's doing well, but underneath the waves, there's some trouble going on. We have a lot of new highs and new lows. That's typically not a sign of a healthy market. So it tends to precede trouble. And here you see, this goes back to 2020. In the far left, right before the COVID crash, we got some signals. And then before the 2022 bear market, I think we saw quite a lot of signals here. And then again, some of the pullbacks that we've seen in the last few years, even though the market's turned around and gone back up, have been presaged by Titanic syndrome signals. The Hindenburg omen is similar but different. If the S&P is above its 50-day average and both highs and lows are more than 2.8%. So in other words, there's a lot of stocks making new highs and there's a lot of stocks making new lows. That's a sign of trouble in the market. It shouldn't be like that. In a true bull market, you should have a lot of stocks making new highs and a few, at worst, making new lows. And then also, just for fun, we throw in McClellan oscillator must be negative. And when that happens, we get a Hindenburg omen signal. So again, if we go back prior to 2000 or during 2018, prior to the COVID sell-off, before the bear market, and then we've had a few in the last year, haven't really amounted to anything yet. So from there, we take those two items, the Titanic syndrome and the Hindenburg omen, and basically it's a little bit of hieroglyphics, but the average over the last 10 to 200 days. And what we get looks something like this. This is the Titanicburg, as I call it, indicator, and basically spikes suggest churning in the market and suggest that things maybe are not as good as they look. And for my use, I look for, using the NYSE version, I look for a cross above 19 as a quote unquote warning sign. Note that I didn't say sell everything, panic, run for the hills. It's a warning sign that the market may be in for some trouble. Could be a lot of trouble, could be a little trouble. It's a hint, it's a sign. It's not necessarily a sell signal on its own. But if we take a closer look at these signals when it crosses above 19, you can see them marked here. This is using our backtest engine. And what we find during the test period, there were 13 times when we got a signal above 19, a win rate of only 30%, meaning the market, 70% of the time, the market declined following that signal. So that's a pretty good sign. And also note, it's only active 3% of the time. So one way to think about using this is if you are an investor who will occasionally hedge a portfolio, whether that's raising some cash or buying put options or selling calls, something like that. This is a very good time when you see this kind of signal. It's an excellent time to think about hedging your portfolio because you won't be in that for long with that 3% number, but you may save yourself some pretty good money. And here's kind of a closer look at some of the signals over the years. And the key thing to note is down here in the red box, over the next 3 months, the win rates are in the 30% range. That's extremely low historically. The stock market typically is 58 to 65% for each of these periods. So, and the median is a loss. Now, longer term, if you look over at the far right, the 1-year column, sometimes the market bounces back and does just fine, but also sometimes it warns you of a bigger bear market, like in 2000, in 2007, and then also in 2021. So definitely worth keeping an eye on, even if you only look at it once a week. Even once a month might help you out. So that is the Titanicburg. And here's the equity curve of those trades. So as you can see, you could have saved yourself some money if you had raised some cash or hedged your portfolio while these signals were in place. On the flip side, one thing I've noticed, we're going to flip over now to the NASDAQ version. So we're using the NASDAQ Titanic syndrome, NASDAQ Hindenburg, and the same calculation. What we're looking for is super low readings. That means that there's either not many stocks making new highs, which by the way is bullish because it tends to imply a massive sell-off, or very few stocks are making new lows, which also is bullish because it tends to signify a bull market. So if I kind of zoom in a little bit on the last couple of years, you see a couple of instances where it got down below, I think it's a reading of 1, the 20-day average, and you got some pretty good follow through to the upside. In fact, I think I have that right here. So this strategy looks for a 20-day average of the NASDAQ Titanicburg to drop below 1, and then we'll sell either after 12 months or if there's a 15% loss. And just cut our losses and get out. And you can see the signals here. And again, in most cases, when this thing dips down low, it's telling you market's either washed out and it's near a bottom, or it's surging and it's likely to continue. And so this is how that works out. A win rate of 80%. There were 2 that were stopped out for a loss, about that 15% loss that I mentioned. And again, this is more of a trading indicator, trading model for aggressive traders, only in the market about 20% of the time. And then here is kind of give you an idea how that looks. And then so these numbers over here, you see this signal in 2021, you would have got stopped out in about 2 weeks. And you would have said, well, that was a stupid trade. I shouldn't have done that. But you'd be glad you got out 10 months later. And same thing in 2008. So this one, I use a stop loss, but otherwise try to play it pretty aggressively. And here's the equity curve. The winning trades, the 15% stops. And then so we're going to switch over to Dean now to talk about the market environment composite.
Jason recently published a research report with his market environment composite. That composite contains 8 indicators. 5 of those are breadth-based, 3 are trend following. And so I had Hal and the programming team add that to the website on its own page. So similar to what we did with the risk on, risk off indicator, if you go under spotlights, you'll see the market environment composite. If you click on that, then you'll go in, you can see the chart with the S&P 500 and then the individual components that in that composite. So another sort of market, what we call overlay type of indicator that you can utilize just to have a general understanding of the environment, just like with the risk on, risk off indicator. And we've also, with both of those indicators, risk on, risk off, and the market environment composite, we've created, again, just an overlay indicator within the backtest engine. So if you go into the backtest engine and use the search function and under sentiment and you type in risk on, risk off, you'll see the composite indicator as well as the overlay. The overlay will just basically have a reading of either 1, which would be positive, or 0, negative. And then the same thing with the risk on, risk off, and the market environment composite has an overlay in there. 1 is positive, 0 is negative. And so what you can do when you're creating a strategy or a study is you can use those as overlays. So for instance, you may say, well, I want to buy Apple when our trend score and our relative trend score both reach a score of 8 simultaneously, but I only want to do it when the risk on, risk off overlay is positive. And again, you can do the same thing. You can use the risk on, risk off indicator, or you can use the new market environment composite overlay. So it just gives you, another sort of indicator to tell you that, okay, everything looks good or bullish, or everything looks bad and bearish, and you can act accordingly. So when you get a minute today, go check that out. It's again, it's under Spotlight's market environment composite, and it's another tool that you can check on a daily basis. Sort of my routine. Let's go in, let's see what the risk on, risk off indicator reading is. Then let's look at the market environment. If they're both bullish, then we need to have a bullish bias in the marketplace. Just one other thing, again, just touching back on a few things. Jay mentioned his model and how real estate typically does well when that LEI model is positive like it is now. The reason for these trend scores is to give you sort of that catalyst or that signal. So if Jay's model is now positive, LEI model is positive, and that says that real estate should perform the best, as he said, it may not perform the best, but now we have a tool where we can go in and look and see, okay, we know it should be positive, but is it positive? Or we can monitor it and say, okay, now LEI model is positive. Let's set up the trend score parameters in the backtest engine. And when it triggers, now I'll get a signal so that I can know to go long real estate. If you go into the trend score indicator page, you go to domestic ETFs. We've got the S&P 500 real estate ETF in there, and I'm pretty sure we have IYR, which probably has the longest history in terms of a real estate ETF. You can see what that trend score is and that relative trend score. When both of those go to 8 or higher, then we probably know this is a good time to own real estate with the backdrop of the LEI model's positive.
Yeah, that's a great suggestion, Dean, because a lot of what we do is we call it weight of the evidence, and just kind of trying to stack factors on one side of the ledger or the other. So yeah, like you just mentioned, if the overall backdrop should be, quote unquote, should be favorable, doesn't mean it will be. So what you're talking about with the relative strength trend scores, that's a great add-on to say, okay, now this sector is actually starting to move, and now is the time to get in when it is actually moving, rather than buying and waiting around and hoping that it'll bounce.
Exactly. And then just one other thing in terms of the new Titanicburg indicator, sort of generally speaking, for people that don't know, but the NYSE data has bond proxies in that group of stocks/securities. So a lot of times when you're looking at the NYSE, whether it's just 52-week lows or highs or these subset indicators. The NYSE will generally can be influenced more by the bond proxies, okay? And that's a good message. If bonds are not acting well, as Jay showed with his TNX range model, that's a message in and of itself. And so again, with NYSE, you get the bond proxies. And a lot of times when you see those sort of whipsaw signals and uptrends, it probably means that bonds were doing something, weren't acting well. And a lot of times if bond yields are rising, right, and the stock market's in an uptrend, that means the economy is good, okay? And bonds will react. If the economy is acting well and it's strong, bond yields are probably generally going to rise a little bit. And then on the flip side, with the NASDAQ, what we know about the NASDAQ is that it has a lot of junk in it. But paying attention to what the junk does is also very important in terms of a market tell. When the junk is all rallying, that's generally a pretty good sign for the markets in itself. That means that breadth is broad and look, there's plenty of liquidity. That one has a message in and of itself, as well as the NYSE data set. So just wanted to sort of throw that out. I don't know if Jay, if you have any more thoughts on that as well.
No, that's an excellent point. That's an excellent point. So what I'm going to do is I'm going to go over to the questions. Only a few today, but I want to start with this one. What trend inflections, beginning or ending, do you see developing? I'm just going to give you a quick overview of where I'm at in the markets. The stock market, the things that I follow are still favorable, so I'm still bullish stocks. Overall, the things that I follow in the in the bond market are still not favorable. I keep reading that rates are going to plummet and bonds are going to soar. And on a technical basis, TLT seems to be bottoming out. It seems to be making a head and shoulder. It's trying to rally, but it hasn't done it yet. And so at this point, I'm just not, with the stock market doing well, with a few commodities doing well, I don't see any reason to commit a lot of money to the bond market at the moment. Just an opinion. And then the other thing, the commodities, some of these markets, gold, silver, the metals have been looking pretty good. Although I have a piece coming out today that is a bit of a warning sign, but more of a yellow light than a red light. So I'm focused mostly in stocks and commodities. One thing that I wanted to show you, and I don't have it, is I wrote an article. Maybe I'll put it on our Twitter feed about the dollar. So just let me try to sum this up very quickly. There's an 8-year cycle in the dollar. Essentially 4 years, it tends to do very well. 4 years, it tends to do poorly. It's starting a poor 4-year period in 2025. Interestingly, what I wrote about in that piece is January and February tend to do okay in year one, which is what 2025 is, year one of this cycle. After that, March through December have historically been extremely weak for the dollar. So that's not a prediction. That's just saying historically, that's something that I want to pay close attention to. If the dollar starts to break down in a meaningful way, I believe it will follow through to the downside. And that has implications if you're trading currencies. If you're not, it also has implications for commodities. Lower dollar value tends to lift commodity prices. So with some of these commodities looking good and the dollar looking shaky, I'm hoping there's an opportunity in this year for commodities to do pretty well. So that's kind of where I'm at. And now for a different perspective, Dean, what are you seeing right now?
Yeah, well, I mean, not a whole lot too much different from what Jay said. I published a piece on the breakout in commodities, so that's one thing that I'm really watching here closely. We know that global, central banks around the globe are still easing, and as Jay said, if the dollar were to start to break down, that will benefit commodities as they're priced in dollars, and so look, I don't think we're, as I said in my note, we're still a long ways from that sort of inflation type of signal that's negative for equities, but it's something just to keep an eye on over the next, probably year, that if we see another big up leg in commodities with the weaker dollar, that we'll need to start really watching these and monitoring these inflation measures that Jay's created and I shared in my note. So that's what I'm kind of looking at. From the stock perspective, look, we've had this consolidation, multi-month consolidation. A lot of times what happens is moving averages catch up. So you can see some underlying weakness in market breadth. It hasn't been ideal here, but it's not negative. As Jason's market composite shows, it actually just ticked up to 6. So 6 out of 8 components are positive. The risk on, risk off indicator is still in positive territory. We've had this consolidation, and really shouldn't be any surprise. We've had 2 back-to-back 20+ years in the S&P. For the market to sort of take a break and consolidate is not unusual. There's lots of headline news going on here and there, but the market's been resilient. Again, we just hit a new record high in the face of all these perceived negatives in the marketplace. So I continue to remain constructive, and I think, and what you kind of really see is that a year like this is probably not a great year if you're just an index investor in something like the S&P 500. But
Agreed.
if you utilize our trend score tools and really hold and buy stocks with favorable relative trends, I think you can have a very nice year holding individual stocks in the right sectors that are outperforming. So
Yeah.
yeah.
If I can jump in, Dean, that's a great point, is that there are years when you can just buy and hold an S&P 500 fund, and it's great, wonderful. There are other years when the stock market doesn't do that great, and yet one of the things I always like to say, there's always a bull market somewhere, and everything that we do and everything we write about and all the tools on the website are designed to help you and help us find that current bull market, what's really moving right now, because you can do a lot better in one sector versus the other if you're paying attention to which one is strong. Just a quick example, if you look at large caps versus small caps for the last 15 years or more, if you just insisted on being in small caps, you've underperformed massively for a long period of time. So it's really important, as Dean was saying, to pay attention to what's really moving in the market.
Yeah.
Okay.
And one other just note with the on the trend score page now, Hal and the team have added the Russell 3000 stocks. So there's 3,000 stocks that you can monitor for positive absolute and relative trend score. So there's plenty of opportunities out there to find ideas. And again, the way Jay does it, the way I do it, we're very similar. What you want to do is just determine, is the market bullish? Is it bearish? Okay, if it is bullish, then what groups do we want to be in? And we want to be in those groups that are outperforming. We want the wind at our back. If you can go look at these studies, a lot of times, and I'll share it with subscribers here down the road, but over long periods of time, if you just own the stocks that are in the sectors, the industries, and the sub-industries that are outperforming, you can do very well.
Yeah. Okay, next question. What's the best way to add certain indicators from Jay and Dean's research? Where can I see current positioning? Dean, when you the backtest engine?
Yeah, I mean, I think if the trend score indicators are a great place to sort of start in terms of looking at what we're looking at. If you can add signals into the backtest engine, to monitor that stuff. You know, how the team now has this new My Signals nightly email, so that, you know, if you create 10, 15, 20 signals and maybe say you're just doing it on sector ETFs or industry ETFs, that's what you trade or invest in. You can go in there, set that up in the backtest engine, and then each night you can get an email that will tell you, you know, okay, well, here's what triggered a new signal today. Just kind of what Jay and I have over the last few webinars is just, we've sort of given you a process. We're slowly putting that stuff on the website, whether it's the new market environment, the risk on, risk off indicator. Those are things that we're looking at, or as Jay did today, those are now all in the backtest engine. So you can now set that up and monitor that yourself and get nightly emails when those trigger.
Yeah. One other question we have, do you have data or strategy for sector rotation? Dean, I think you just answered that, right? I mean, that would be the, which part of the website is that? That's in
well, so the first place you could go to would be strategies. So if you go to our strategies page, within there we have several subfolders. So if you look in the sector folder, we have all 11 S&P 500 sectors in there, and you can see what is currently on a buy signal. I haven't checked it today. I suspect it's not changed, but the last time I looked, it was on a buy signal for communication services, technology, consumer discretionary, and financials. So right there, you can get a quick snapshot of pure relative strength.
Right.
Again, those strategies are just looking at what is outperforming the S&P 500 and has a very simple concept to tell you that this is where you should be focusing your efforts in terms of either owning those sectors or researching individual stocks within those sectors. So that's the first place. On our trend score indicator page, you can go in there and look at domestic ETFs, where you will also see what the trend and relative trend score is for the sector ETFs, as well as hundreds of other ETFs.
Very good. Very good. And then the last question is about tariffs and the potential impact of the tariffs from the U.S. or to the U.S. Dean, any thoughts on that?
Well, look, I published a note yesterday with a broad thrust in terms of stocks in Mexico. If stocks in Mexico are rallying, it probably means that investors are not too concerned at the time being about tariffs.
Right.
A lot of times when stocks rally or breadth-based indicators surge in the face of perceived negative news, that's usually a pretty good sign. For me, I think from an objective point of view, the stock market is telling you that it's really not worried about it too much. I mean, yes, we've had a couple of days here or there where we have a quick one-day sell-off, but then we've recovered right from that. So
yeah. My own take, well, a couple things. That kind of thing falls under the political, and so I try to avoid all of that in my analysis. I will say that probably the worst investment strategy anyone can adopt is to say, I like the current administration, therefore I think the market will do great, or conversely, I don't like the current administration, therefore I think the market's going to fall apart. And a lot of people put their personal bias into their analysis, and that's always a mistake. So as far as tariffs go, I don't have any indicators that objectively can measure the input or the effect of tariffs, so I tend to ignore them. And my advice is put together your own process, your own strategies, make sure you have some kind of a stop loss feature, and Don't worry about every, I would call them a shiny object. Tariffs are a shiny object. People go, oh, wait a minute, this is something different. This is something new. And everybody will tell you it's going to be a big deal based on their own political viewpoint, and who knows? So develop your process and follow it, and you'll be much happier and you'll do much better in the markets. And that's my comment on that. So that is all we have for questions. So Dean, you got any other thoughts on the markets today?
No, I mean, I think generally speaking, we're okay. Drill down to individual sectors and stocks rather than say per se owning just the S&P 500. I think you'll probably have a better year by doing that.
Yeah. Yeah, and the last thing I'll mention is I put out a piece yesterday. I found from someone else about the Valentine's Day. The S&P 500 index is up 3% or more for the year by Valentine's Day. Historically, that's happened 32 times. 30 of those times, the S&P 500 was higher by the end of the year. The average was about 13%. So does that mean that there is a 92% chance that the S&P is going up 13% between now and the end of the year? That's not exactly how it works, but those are the historical numbers. So what it tells me is simply to continue to give the bullish case the benefit of the doubt until given some reason to think otherwise. And that's all I've got.
Right.
So I think we're going to wrap it up there. I want to thank you all again for joining us. If you have further questions, you can let us know. And thank you for being a subscriber, and thank you for joining us today.